Hi everyone, Jim Lorenzen here, and today we are going to be discussing one of the most important retirement decisions you're ever going to make. What should you do with your retirement money when you retire from your employer plan, like your 401k, 403b, or whatever? A lot of people think this is an easy choice, but that's rarely the case because depending on your particular situation, you may have up to six, yeah, count them, six different options to choose from. So grab your coffee. I got mine right here. Oh, good. Okay, grab your coffee, take some notes. Don't worry if you don't memorize or absolutely learn everything you're going to hear today. The very fact that you're going to be aware of these things is actually going to put you ahead of an awful lot of people. So, there are six options available. We're going to be talking about all six, and we're going to be talking about the pros and the cons and the pitfalls and the things to look out for, as well as the benefits. So, before we get started, though, here's a little bit on my background. I am a certified financial planner. I am an accredited investment fiduciary. I've been in private practice since 1991, and retirement and wealth management for retirement has been my focus for my entire career. I love doing this because this is the one area where I can actually make a difference in other people's lives. And as you can see, there is a difference to be made. Before my advisory days, I was a business owner. I founded, built, and sold a number of businesses. I also spoke at a lot of conventions all over the United States, Canada, and England. And I've done a lot of consulting work. I've been done interviews and been in articles, blah, 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 stuff like that. It's all on the website. If you'd like to look at the website, it's INDFIN. That's short for Independent Financial, INDFIN.com. Okay, one more thing we should say. I am not a lawyer. I'm not a CPA. So legal and tax questions should be referred to the proper people, professionals in those areas. Now, in my practice over the last 30 plus years, I've done a lot of work with clients, attorneys, and CPAs as part of a team and helping them arrange their financial house and getting it in order for themselves, their family, even their children and their heirs. So remember, nothing you hear here is investment advice. In fact, it's not any kind of advice. Advice is something you get from a professional as part of a comprehensive formal written plan. I don't care if you're building a house to live in or your financial house, it all begins with a blueprint, a plan. Things that don't have plans don't turn out very well. So that should be everybody's starting point in arranging the rest of your life. Okay, we said there are six options. In a nutshell, here's the six. And then we're going to talk about the pluses and minuses of each one. Number one, leave your employer plan assets right where they are with your existing employer's retirement account. If you have a 401k, for example, maybe you just leave your employer and just leave them there. That's one option. Number two, roll your plan assets into a new company's retirement plan. Say you're changing jobs. You can do that. Some people do. Roll your plan assets to an IRA. That's option number three. And that's what many people do. Number four, take a lump sum distribution of your plan balance. Not usually a good idea. However, believe it or not, there are rare instances where this actually could be a good choice. We'll talk about that. Number five, convert your plan assets to a Roth IRA. Well, if you want to set up a Roth, that's a good way to do it. Number six, make an in-plan Roth conversion of your plan assets. That's where your employer may offer the Roth option as well. Okay, let's take them one at a time. Number one's a simple one. Leave it in your company plan. Don't do anything. Just leave it there. You know, if you choose to do nothing, that's exactly what you're doing. And it's not necessarily a bad idea. Most of you will have this option available to you, but remember, there are a few times when an employer plan will actually force you to take a distribution. Now, generally, this won't happen, but you've got to check the plan rules. Every employer retirement plan is different. They're all different. They all have their own rules. And believe it or not, quite often, their rules are more restrictive than even the IRS. Believe it or not, that's true. So don't assume that one employer's plan, another employer's plan is just plan to plan, and be careful. They're not the same. Okay, Common reasons to leave your plan assets in your current employer plan. If you're lucky enough to be retiring early, or if you left your former employer in the year you turned 55 or later, you can take penalty-free distributions from the plan sponsored by the company you just left. You don't have to wait till age 59 and a half. How about that? So if you are 59 and a half, of course, or older, then that's not a concern. By the way, certain federal, state, and local public safety workers have plans that allow distributions at age 50 or later. So you want to be able to check the plan rules again. Now, the most common reason people leave their assets in their employer plan is creditor protection. If that's a concern for you, it may be a reason to leave your money in that plan because creditor protection is offered by the Employee Retirement Income Security Act. It's a federal law known as ERISA. Now, ERISA does offer creditor protection that offers safeguards of covered funds from most creditors. Now, on the other hand, IRAs, Roth IRAs, and plans that don't receive creditor protection or ERISA quite often do under state law. So you want to be able to check your state law on that. Okay, fees. That's something else. And services. You want to be aware of what the fees are inside your current plan as well as elsewhere. Some fees may be hidden. You got to do your homework because there's no such thing as a free plan. Now, your plan may offer lower costs or not, maybe not, but you have to check. But the opposite could be true. An IRA might even have lower fees, even with an advisor, believe it or not. That could be true too. You have to check. But there's a final thing to consider, and that's the value you're receiving for the services that are being provided. My mom used to say, some people know the cost of everything and the value of nothing. And she's right. You have to know what you're getting. Whatever the difference is the service you're getting worth the difference? And if it is, then cost isn't the only cost is just a function of value. Okay, no solution is going to be right for everybody all the time. That's important to understand, and the old employer plan is no exception. There are any number of reasons why leaving money in the employer's plan may not make sense for you, and here's some of them right here. Eligible designated beneficiaries may not be allowed to stretch distributions in the plan. You got to check the plan rules. Look down there a little further. 20% of your distribution may be withheld for federal income tax purposes. This is more often the case than not. And investment and other fees may or may not be higher. Again, you got to check that. Estate planning in a company plan may be more difficult than if your assets are moved somewhere where you actually have control. Those are all issues to be considered, but they don't all apply to everybody. Now, if you do decide to move money from your employer plan to a plan that you control, an IRA, for example, or a Roth or whatever, it's important to understand there are two ways to do it. One is called the indirect rollover. It's known as the 60-day rollover. And the other is called a direct rollover. That's really where the money goes from custodian to custodian. For example, in your employer plan, your money may be at a custodian that actually has, in fact, it will be at a custodian where a custody account actually has physical custody of your assets. That's a tongue twister. But it's important to understand that a custodial firm is the firm that has physical control and custody of your assets. If you have an IRA and you open it up with another company, that's another custodian. A direct rollover is a custodian to custodian transfer that's direct. It doesn't go through you indirectly. Now, I'll tell you what the differences are. Let's start with indirect. In an indirect rollover, the distribution is made payable to you. The money is made payable to you. You get the check. You have 60 days to complete the rollover into a new retirement account. Note the words, complete the rollover into a new retirement account. And by the way, there's 20% mandatory withholding. Now, what that means, if the check comes to you, let's suppose you have a $100,000 IRA, or a 401k, I mean. If you have a $100,000 401k, the check comes to you payable. There's 20% mandatory withholding right away. Your check is going to be for $80,000, not $100,000. Now, You get a check for $80,000 from your $100,000 401k. You have 60 days to complete the rollover. Now, sometimes we get busy. 60 days goes by pretty quick. We get busy, other things happen. And if you miss that window by one day, you could have a problem with the IRS. We don't want that. So make sure you do it within 60 days. But that 20% mandatory withholding is worse than you think, because you maybe put the $80,000 in that new retirement account and you did it within the 60-day time period. Has the rollover been completed? No, it has not. Because it was $100,000 in the old. To complete the rollover, there must be $100,000 in the new retirement account. That means you have to make up that $20,000 that your employer plan withheld. You have to make up that $20,000 from other assets and add it to the 80 that got rolled in order to complete the rollover. You have to make up the difference. 20,000 may not sound like the end of the world. Suppose your suppose your 401k is $500,000. Now there's a $100,000 withholding. You put $400,000 into the new retirement account, and you have to come up with $100,000 to complete the rollover within that 60-day window. Not good. Much better to do a direct rollover. In a direct rollover, the funds are sent right from the plan to your new retirement account, custodian to custodian. No 60-day rule, no mandatory withholding. Much cleaner, fewer things go wrong. In fact, a lot less goes wrong, if anything. And to tell you the truth, I've never seen it. In 30 years, I've never seen anything go wrong yet. There's an important thing to understand, though. Not all employer plans will want to send the check to the new retirement account directly. They say, well, we have to send it to you. You're saying, wait a minute, I don't want to do withholding. Here's the way it works. The check is made out to the new company, the new custodian, whatever the company's name is, as custodian, for the benefit of your IRA. So it's made out to the company, not to you. You don't cash it. You do not take possession of the funds. No withholding, no 60 days. The check's made out to the custodian for the benefit of your IRA, and it's made out for the full amount. And the check, by the way, comes to you, so you know where the money is. You want, actually, the check coming to you, because if it goes custodian to custodian, you don't know where the money is. You call up your old employer. Was the check sent? They said, yeah, we sent it last Thursday. You call the new custodian. We haven't received it yet. You're stuck in the middle and you don't know where the money is. Much better. The check does come to you made out. Now, if you haven't received it, it's just between you and the old plan. You've taken that third piece out of the puzzle. The money comes to you. You know where it is. You get it to your new custodian. You can send it certified, registered, or you can hand deliver, whatever. But the money then goes to the new custodian for the benefit of your IRA. And down there in the memo column where it says direct rollover, that's where you write your new account number, because you open the account ahead of time. Then you get a check to deposit. That's the way it works. It's clean. It's simpler. No 60-day deal, no withholding, and you know where the money is. Okay, option two. Option two is if you go to work for a new employer. New employer has a plan probably, and you might be able to roll your old plan funds into your new company plan. But here's the thing to remember. Plans don't have to allow rollovers from other plans. Remember what I said? Plan rules differ from plan to plan, and often they're more restrictive than the IRS, believe it or not. Now, another reason you may want to do it, the same reason that you might leave it in the old plan, frankly, strong creditor protection, if that's an issue for you. By the way, there's also the possibility of purchasing life insurance with plan funds, and maybe the ability to have lower fees. You want to check the plan rules. I'll say it again and again. Now, when rolling money into a retirement plan, there are some additional benefits. You might be able to take a loan. You might be able to take a loan of up to $50,000 from your employer plan. You can't do that with an IRA. Taking a loan from an IRA is what's called a prohibited transaction. If you had a $1 million IRA and you would take a $1 loan, the IRS will treat that entire million as having been distributed and taxable to you. Not good. So, another reason you may want to have it in the plan is you might be able to purchase life insurance with money inside your plan. By the way, remember one thing, you can't do it with an IRA, but you also cannot roll life insurance into an IRA later. You can't do that. So it's important to know. The most common reason why people roll money from the old plan into the new plan is simply consolidating their funds. In other words, they don't want 50,000 pieces of paper. They don't want 2 or 3, 4, or 5 retirement plans. They want to be able to have one plan with all their investments in one drawer. They want to be able to know where their money is without a lot of statements to worry about. And that's the most common reason. Again, this strategy is not for everybody because it's very similar to the first option. As you notice, it's kind of like the same slide we showed you before about advantages. Whether it's an old plan or new plan, pretty much the same. Okay, number 3. The third option, you could roll your money into an IRA, your own IRA, one that you control. It could be an existing IRA or you can open a new one, but that's an option that's very, very common. In fact, maybe the most common. Now, the most common reason that people do this is because they want to broaden their choice of investment options. Instead of being in the old company plan where they were inside of one mall with a number of department stores, you remember those? Instead of being in a mall with department stores, they can now shop all the stores and all the malls everywhere. They have a huge universe of investments available to them. The only things they can't buy inside their IRA, life insurance, collectibles, and S-Corp stock. That's it. Other than that, they can pretty much buy anything they want inside their IRA. There may be some other minor limitations, but that's pretty much the ball game there. So another common reason, though, is they want to consolidate their retirement savings. Again, fewer statements. And there's a reason for this. The Department of Labor did a report on a study that they released that baby boomers born between 1957 and 64 had on average over 11 jobs between the ages of 18 and 46. Believe it or not. Now, you probably don't have 11 different employer plans, but it's very possible you could have participated in 2 or 3 and left one somewhere and over the course of your career forgotten all about it. An IRA can serve as a very convenient collection point. Again, keeping life simple. Now, IRAs often offer more attractive withdrawal options than employer plans do because employer plans, like I said, have their own rules and they can be very restrictive. With an IRA, you can generally request a distribution whenever you want one. And if you leave your money in your old plan, you can roll it over a new one, but you're stuck with the plan rules, whatever they are. In an IRA, you actually have a lot more flexibility generally. But another big difference, IRAs on the withdrawal side have no mandatory 20% withholding of IRA distributions. You can elect to withhold 10, 20, or 0. It's up to you. And by the way, when it comes time to take required minimum distributions, RMDs, IRAs have another advantage. As a general rule for plans, RMDs have to be calculated on each account separately. Now, in employer plans, they have to be distributed separately, but in IRAs, they can be aggregated. Here's an example. John and Jane both have big IRAs, and they've calculated their RMDs for the year. They both have exactly the same RMD requirement. John calculates the RMD for each of his 3 IRAs. It comes to a total of $10,000. Jane, she calculates them for her 3 401ks, and they come to $10,000. They're identical. Only one thing, John can take that entire $10,000 from any one of his IRAs. Jane can't. The 5, 3, and 2 have to come out of those specific 401ks. She can't aggregate. So that's something worth being aware of. So, common reasons to roll into an IRA. Well, one of the big reasons is there can be estate planning benefits, making it easier after for your beneficiaries after you're gone. You can consolidate accounts. You can actually create multiple accounts with each with their own beneficiary designation. So that's important to understand. Remember, some employer plans may not accept certain beneficiaries, like a trust. They may not also allow customized beneficiary forms that allow beneficiaries to utilize certain strategies, like disclaimer planning. Believe it or not, there are times when, if there are three beneficiaries, for example, to a retirement account, one beneficiary may elect to disclaim his or her uh, inheritance in favor of one or the two of the other beneficiaries. Might be because of whatever reason. It could be because of college funding eligibility. There's all kinds of reasons it could happen. But you can do that with an IRA. You cannot do that with a 401k. So another one is preserving the stretch options. So that's important to understand. There are pluses and minuses. Okay, there are a number of benefits for rolling into an IRA. These are the most common: broader array of investment options, more flexible distribution options. You don't have the withholding issue. Simplify RMDs. You can aggregate between multiple IRAs. You can enhance your planning options. You basically, what it comes down to is you have greater control than you do being subject to plan rules, which are often, as I said, more stringent. Okay, well, nevertheless, it's not perfect. There are downsides. Note the last item. After the passage of Secure Act 2.0, as it's called, the first distribution age is 73 for those who attain age 73 from 2023 to 2032. And the age actually moves up to age 75 for those attaining age 74 in 2033 or later. That may not sound like it's a big deal, but you know what? When the distribution RMD required age goes up, that can and those, by the way, are calculated according to lifetime expectancy tables. If the distribution age goes up, that means there's less time to empty it out and get the required minimum distributions out, which forces the amount of money up. If the withdrawals have to be greater, it could force people into higher tax brackets. And if that happens, and even if it doesn't happen, it does increase your income that year. By increasing your income, even if you don't go into a higher bracket, by increasing your taxable income, it affects how your Social Security taxes on your Social Security are calculated. It also affects your Medicare premiums. So these things have a ripple effect. It's very important to understand that. Okay, fourth option: taking money out of the plan, cash out. Just take the money and run. Generally, this is not a great idea. You lose tax deferral on those funds because you don't pay tax, by the way, on interest, dividends, and capital gains while they're in there. But nevertheless, even though you lose deferral and the money coming out is a taxable event, a lot of people, believe it or not, still cash out after they leave their employer. This is generally not a good idea, but it's not always the case. There are a few times when it can make sense, because if you're lucky enough to have the right set of circumstances, cashing out of the company plan might make a lot of sense because of tax breaks that you otherwise would not get. Tax breaks like net unrealized appreciation, NUA. What is that? Well, before we talk about NUA, let's first talk about what is a lump sum distribution when you take it out of your plan, just cashing out. It means the entire balance has to be taken out in 1 year, not a 365-day year, a calendar year. If it's June, it means it has to be liquidated by December 31st of that year. If not, it's not a lump sum distribution, and you won't be able to utilize special lump sum distribution tax breaks. So that's a very important thing to understand. And there are 4 triggering events that allow a lump sum distribution. 1, death. I don't think you want to do that one yet. Number 2, reaching age 59 and a half. That's a triggering event that allows it. Separation from service means you've retired, resigned, otherwise left your employer. By the way, if you're self-employed, you can't fire yourself to do this. So that's important to understand. But if you are self-employed, disability is a triggering event for the self-employed only. But the definition of disability is pretty restrictive, so you got to be careful. All right. Now that we know what a lump sum distribution is, let's get back to NUA, net unrealized appreciation. Sometimes company retirement plans like 401ks will allow you to invest your retirement money in your company's own stock. You work for a company, they offer their company stock as an investment option in the plan, you make the investment. Any gain that you earn on those shares while it's inside the plan is known as net unrealized appreciation, and it's eligible for special NUA tax breaks. Now, at its heart, the NUA strategy is nothing but a tax move. For a portion of your retirement savings, it allows you to trade ordinary income tax rates, which you would have by just withdrawing money from your plan, and get long-term capital gains rate benefit, which at today's rates could be a savings of up to maybe 20% or more. Check your current tax structure. Now, to see how exactly this thing works, remember there are three important rules. We've already discussed two of them. Number one, everything has to come out in the calendar year. Number two, the distribution has to take place after a triggering event, and we discussed those four triggering events. Final requirement, your shares of company stock must be distributed in kind, very important, in kind, to a taxable account, not an IRA, not another 401k. They must go into a taxable, like a joint account or an individual account, but they have to go into a taxable individual or joint account. And the shares must go sideways. They have to go in kind. You cannot sell out the shares and do the cash. They have to go in kind. So shares go sideways into a taxable account. A lot of people will roll it into an IRA. That's a big mistake, because if you do that, you irrevocably lose the ability to make it an NUA transaction. Now, if your head is spinning, I don't blame you. It's a powerful strategy, and it's okay. If all you take away from the presentation is that NUA is something to explore with your tax advisor and your financial planner, then that's good enough. Right now, you don't have to be an expert on this. It's just important that you're aware of somebody says you don't have to know all the answers. It's just good to know all the questions. So that's an important thing to understand. Okay, if you're not sure if this applies to you, all you have to do is ask yourself two questions. First, do you have company stock inside your employer plan? If it's no, don't worry about it. Second, if you do have company stock, has this stock gone up in value significantly? If the answer is no, don't worry about it. But if the answer to both questions is yes, then this is something you need to talk with one of your advisors about. That's all you need to know. You don't have to be an expert in it. All right. There are other special tax breaks available for lump sum distributions, like 10-year averaging and pre-1974 capital gains elections. Now, these are still lump sum planning strategies, so everything out in 1 year still applies. That rule is still there. Key takeaway: if you're eligible to take a lump sum from your plan and you were born before 1936, or if you had money in your plan on December 31st, 1973, there could be additional tax breaks. Explore them with your tax professional. And of course, with these strategies, they can be very powerful, but they're not for everyone, as we keep saying. Here are some reasons why it may not make sense for you. I'll let you take a look at the slide. No stretch for beneficiaries. You might have 10% early distribution penalty. You got to check into that. All or a portion may be subject to 20% mandatory withholding. Check your plan rules. And all or a portion may be immediately taxable. You got to check on that. Okay. Now, option number 5. Convert to a Roth IRA. This is very simple. It's like an IRA conversion that we discussed earlier. The only difference is the money goes from your plan to a Roth IRA, but guess what? The money you convert is taxable. That's a taxable event. You're taking it out of a tax-deferred account, putting it into a Roth. The amount you converted will be added to your tax return for that year. So you have 100,000 in your traditional 401k, you want to convert it to a Roth IRA. We'll talk about why you might want to do it later in a few minutes. But if you move forward with that, the $100,000 comes out, it's added to your taxable income for the year at whatever tax rate you're at. So you want to discuss this with your advisors ahead of time. Make sure, again, if you're working with a certified financial planner, there's no doubt in my mind that this will likely be a very integral part of your planning process, which will weigh the advantages, pros, and cons of whether or not this makes sense for you. Okay, benefits of an Roth IRA conversion. Well, the biggest benefit is the potential for tax-free distributions from a Roth IRA in the future. Because once you've done the conversion, if you're over 59 and a half, and if you've had your Roth for more than 5 years, then all distributions from any of your Roth IRAs will be tax-free. Now, if you haven't had it for 5 years, you're over 59 and a half, but you have not had it for 5 years, you can still take the converted amount tax-free because that money has already been taxed. Now, if you're younger than 59 and a half, other rules apply. Make sure you want to talk to your advisor about that. Now, don't forget that a lot of people feel like tax rates are going to be higher in the future because of our increasing national debt. That's important to understand. If you're one of those, the benefits of a Roth are probably not lost on you. Okay, let's take an example. Jane's 60 years old. She has $100,000 in her IRA. She converts it to a Roth, and it grows to $300,000 by the time she's 70 years old. 10 years, gone from 100 to 300,000. Well, because she's older than 59 and a half, because she's had it more than 5.5 years, she's had it 10, she can take any of that money or all of it out anytime she wants, at any rate she wants, anytime for the rest of her life, tax free. No RMDs, by the way. So if Jane needed the money, so let's say when she was 63, that's within the 5-year limit. She can still take out the original 100,000 tax free because the taxes have already been paid on that. Now, there are additional benefits. Like I said, if tax rates rise in the future, it's important to understand that. But we already talked about the fact that because of Secure Act 2.0 raising the RMD age, it's going to increase the amount of money that comes out each year when the life expectancy tables are used. And that could mean more taxes, which affects Medicare premiums and the rate at which Social Security is calculated. Very important to understand that. Right now, a lot of people believe taxes are on sale compared to what the rates are going to be in the future. But I want to repeat it again. It's worth repeating. Roth IRA distributions are not included in the calculation determining how much of your Social Security income is taxable. And by the way, municipal bond interest may be tax-free, but believe it or not, municipal bond interest is included in the calculation determining how much of your Social Security is tax-free. Roth distributions are not. And because it keeps your income lower, not being in a regular IRA where it comes out with taxable distributions, it doesn't affect your Medicare Part B premiums because Roth IRA distributions are not taxable income. Doesn't affect Social Security taxation, doesn't affect Medicare premiums. Very important. Okay, benefits of an IRA conversion, Roth IRA conversion. Roth IRAs have no required minimum distributions during your lifetime. Now, it's important to understand, though, and you have to be aware of this. Because of the Secure Act 2.0 legislation, employer Roth plans also have no required minimum distributions. So it's true of both Roth IRAs and Roth 401ks. So during your retirement, you can take as much or as little as you want. You're not forced to take anything at age 73 or 75 later, or whatever it turns out to be for you. You don't have to. The Roth IRA can continue to compound and grow tax-free for your heirs. And speaking of your beneficiaries, non-spouse beneficiaries like children do have to take RMDs from inherited Roth IRAs. But those distributions are still generally tax-free as well. So that's important to understand. Well, you probably know what I'm going to say. Yes, this isn't right for everyone. Everyone's situation is different, and that's why you do individual planning and you don't just get cookie cutter advice that somebody on television might tell you applies to everybody like you, and not likely. Okay. Final option, the in-plan Roth IRA conversion. Now, this is a new option, and it may not be available to all of you because not all plans, not all employer plans offer Roth IRAs. If you do this in an in-house, employer Roth IRA conversion, you're still taking pre-tax money from the old IRA. You're going to pay tax on it, and then you're going to put the money into the Roth for future retirement. The only difference is it's coming from the traditional side of your company plan and going to the Roth side, but it's all inside the company plan, but it is a taxable event. The taxable funds are going to a Roth 401k, not a Roth IRA. Why would you consider an in-plan conversion? Well, from a tax perspective, the impact of a Roth IRA conversion and a Roth in-plan conversion are pretty much the same. You add the amount you convert to the income for that year. It meets certain guidelines, distributions, or be tax-free in the future. You're really making two choices. Number one, Roth conversion makes sense for you. And number two, you're better off keeping it in the employer plan than moving it to a Roth IRA, even though you gain control because maybe creditor protection is an issue or something like that. We discussed that earlier. Okay, last time I'm going to say this. It's not for everyone. Everyone's different. Everybody has their own unique set of circumstances. As a matter of fact, every decision you make in investing all your life, there are always positives and negatives. Better said is that there are always reasons it might be appropriate for you and reasons why it might not be. That is always going to be the case. You will always be weighing advantages and disadvantages and choosing the option that makes the most sense given your particular situation. I have never in 30 years found a situation where everything is all good and there's no bad. I've never found that. So it doesn't happen. Everything has pluses and minuses. It's important to do homework. And it's important for your advisors to let you know what both sides of the coin are. A good doctor does that. A good dentist does that. A good attorney does that. A good advisor does that. Okay. It is complicated. It's actually more complicated than most people realize because, let's face it, these plan assets that you have represent years, a lifetime's worth of savings. And few retirees are aware of all their potential options. The fact that you've gone through this shows that you're already ahead of the game, just being aware. And of course, we're here to help. I'm always here to answer questions and things like that. If you want to become a client, we'd love to have you because retirement is my specialty. It's something I've been doing, like I said, for over 30 years. There's our website. If you need help, it's simple. Arrange an introductory phone call. How do you do that? You go to the Getting Started page of our website, infin.com. On the Getting Started page, you'll see what the protocol is. It starts with filling out a personal priority review. That's required. Once you give me that priority review, send that in to me. There's no sensitive information required on it. But once you send that to me, it gives me an idea of, well, number one, you're telling me your name and all of that, but you're telling me what's important to you and what your issues are and what you think is worth talking about. Then once you've filled out the priority review, schedule the phone call. There's a link right there to do it. Schedule the call, anywhere from 15 to 30 minutes, depending on how many questions each of us has. But during that call, you'll find out what I do, how I do it, what the process is, and it gives me a chance to address some of the issues in your priority review. And then after that, you can decide if you want to move on from there. It's up to you. At any rate, that's it. That's the whole ball game. I hope I can be of some help for you, and I appreciate you visiting with us here and listening. So I hope I can hear from you soon. Thanks a lot. Take care. Bye-bye.